Welcome to the Accord Mortgages TMA webinar for June 2020. I'm Andy Millard and I'm one of the corporate account managers at Accord Mortgages, and today what I'd like to do is spend about 20 to 30 minutes just covering off some topical and really up-to-date and relevant content that has a broad look at the unusual times that we're in. So we'll touch on things such as our proposition, we'll also touch on the support that we've offered to date and will continue to offer going forward, and we'll also look at our growth series as well. So what we'll look at now is the agenda for today's presentation, and what initially we'll look at is the impact of COVID-19 and how that's changed the way the industry has worked and how that will potentially change it going forward, as well as what it means more broadly for the market and the impact that it's had and what the market could look like going forward as well. And also our response as a lender to COVID-19 and what we put in place to support the broker community. We'll then move on to areas where Accord can help you. So we'll look at what advisors are consistently utilising us for with some real life examples. So we'll look at things like affordability, our criteria offering. We'll touch on our principle-based underwriting approach, which will have some case studies in there as well to bring that to life. Then we'll move into the Accord Growth Series and the benefits that that can bring for your business, and we'll look at why we developed and the purpose of the Growth Series, what it has to offer you, and the success that we've had with it to date. And then finally, what I'll touch on is questions and how we can go about answering those at the end of the presentation. So this slide looks at the impact of COVID-19. And the first thing I wanted to just touch on was changing the way in which we all work. Now, the instant impact of COVID-19 changed the way we worked from the 23rd of March when lockdown began. And one of those things that changed very, very quickly was how we utilised technology. Looking at the increase of Microsoft Teams, Zoom and Skype that were being used more broadly by advisors and also by ourselves as Accord to keep in contact with colleagues or clients or whatever it was. Now, that then starts to make you think about the benefits of technology. And for example, there's potentially twofold benefit there, one around expenditure and then one around income. So if you can work from home more readily and you can use that technology to have those interactions with your colleagues, for example, do you need the office space that you had previously? You might still want an office because you need a high street presence, or it might be that you actually prefer working that way. There's nothing wrong with that whatsoever. But if you're of a business model that actually you're starting to think, well, why are we using the office? This small piece of technology has changed a lot of people's view on that and how they utilise the expenditure that they're making for those premises. And actually, could we just utilise working at home a little bit more, or do split shifts where some of the colleagues go into the office for half the week and then the other half is for the other colleagues, so that we can still get that interaction in the office? Those types of questions start to be asked. From an income perspective, what it does mean is that actually if we're able to video call clients now, what that means is that we can actually potentially reach clients that are outside of our geographical area in a face-to-face way, as opposed to it just being over the phone. So if you're someone who likes to have that face-to-face interaction and you, for example, wanted to get into, say, the London market, a lot of people in the London market would be quite happy to have a lunchtime meeting with you over Zoom or whatever it is to get to know you and for you to start to build that relationship piece. So it also opens up income potential for you to explore other markets within the UK that you've not actually had any exposure to previously. The other thing that it does do, which I think is been really, really prominent from a personal perspective as well, is retaining that work-life balance. So actually, by using video conferencing, you're very much more focused on the day that you have between 9 and 5 and trying to utilise that to the best possible advantage that you have. From my own perspective, it means I'm not travelling around in the evening or very early in the morning to get to places because I'm still having meetings that I would have over video conferencing. But from an advisor or a broker perspective, it means that 9 to 5 doesn't have to just be when you're contacting lenders or you're doing your important paperwork, etc. It means that you could be utilising, as I say, a lunchtime conversation with a client and starting to build that initial rapport, which then stops you having to go out in the evening as well as during the day to go and meet that client in the evening, whether it be over a coffee or at their house or whatever it is. So actually, it's about working a little bit smarter as well. So there's that point to think about. More broadly, I think the other thing in which it may change in the way in which we all work. So generally, downturns in the market tend to go in 10 to 12 year cyclical periods. And actually, it's about thinking about how you can make your business as weatherproof for the next storm as possible. And there's also the mortgage transaction piece, which we're all really, really familiar with, and then we want to talk about the protection side of it as well. But are there other avenues that you could look to potentially go down, such as investments or pensions, etc., which give you other avenues to be able to draw on to get further income from a traditional perspective and a normal perspective of when the market is nice and buoyant. But when challenges come our way, is there an opportunity to turn to one of those other things? Now, it might be that the investment market struggles, so then you return to doing more mortgage business, but it gives you more avenues of choice to go down. The other thing is that a mortgage is generally the first part of a long interaction and relationship that you will have with the client. So if you get that mortgage piece right and the relationship is built early on, then you can then start to look at the pensions and the investment side of things for people as they go through those life stages. So I do think that there's an opportunity there and a watershed moment for people to start to reflect on that as to how they can broaden their business scope and also protect it from future storms that might come down the track. If we look at the industry more broadly, we've had a lot of conversation about APIs in the past and how that will speed up the process of sourcing and keying data in and it going to multiple lenders as opposed to having to do things multiple times. And although there has been a lot of work with that going on in the background, we've not really seen anything material to date. And there's been several years where it's almost been a mantra of it's coming, but nothing's actually material has arrived. And I think that for the industry to see that there are benefits to that, and people who maybe around the table were a bit reluctant to look at those sorts of things now realise that actually there isn't any damage to broker relationships that they are building with their clients, because that's exactly what it is. It's the broker relationship with the client, not the technology's relationship with the client. And also, people can understand the real importance of getting technology right to support the industry and move it forward. So I'd like to think that will also speed up the pace of change that we can get in that space and get that really, really slick system going so that everybody can benefit from that. The other thing that may also speed things up is the Conveyancing Association have also been looking at their part in the transaction and how they can verify ID, for example. And it's all great if we can get the first part of the transaction, which is the introduction from yourselves to the client, and then you to us as a lender, and we can do that really, really quickly. We can get that app to offer time as slim as we like. But then if it then hits the next few stages and they're very much more heavily focused on paper-based and they're slower to transact, that can lose that goodwill that you've built up early on. So the fact that they're looking at that, and again, I think also the challenges that COVID-19 has placed, because a lot of things are more manual based, the benefit that a bit of software or a bit of technology can do to improve that situation if it were to ever reappear again becomes more prevalent, and people become more receptive to actually getting that work done and moving it forward. So I'm hoping that will speed up that pace of change for that part of the transaction, which will make the whole thing much, much smoother. If we look at the market more broadly, up until the point of lockdown, we saw annual house price growth at its fastest pace for 3 years. And alongside that, we saw really strong employment figures, we saw low borrowing costs from the Bank of England, and then regardless of whether you agreed or disagreed with the outcome of the general election, there was then certainty around the outcome there for the market. Many firms and many lenders were reporting the highest volumes of business that they had had for years, and then it came to a pretty much instantaneous stop. So where now? I mean, in the short term, we can start to see a resurgence in the market, but from the medium term perspective, there is uncertainty, but it's dependent on a number of factors. So we've got the wider economic performance, so effectively the bounce back, what will be the longer term effects of the government support packages. Initially, this should be a positive thing as it's shielded businesses and jobs. It's also kept borrowing costs low. So theoretically, it does set the scene for a reasonably quick rebound. Whereas a normal economic shock like the one we have experienced would take a long, long time to recover. So there's many predictions out there whether it would be next year or 2022 where we can start to see the wheels turning fully again and the economy be up and running. But I do think that there is a bit of uncertainty out there, but it will be interesting to see how that develops as we go through. Now, our response at Accord. So what did that look like? So from the moment that lockdown was called and we took very, very clear and decisive action, we moved our telephony support team from the call centre in head office into their individual homes. we took them off the phone and we set them all up for web chat. So there was complete continuity in our ability to support brokers. So the only difference is that if you had called on the 23rd of March, you would have had a phone interaction, but from the 24th of March, it was a web chat interaction because we didn't have the ability to have the phone lines taken straight into the individuals' homes. So it was a case of setting them up with web chat. Now, what we found with web chat is consistently really positive scoring from brokers. So between 9.5 to 10 out of 10. So really engaged with that. What we've also found is the amount of interactions that we can have with brokers has increased. So obviously if you've only got one phone line, you can have one interaction, but with web chats, you can have 3, maybe 4 interactions. And also the wait time for you as brokers and advisors to actually speak to us reduced dramatically. Now, we were doing really well anyway on the phone lines, but the fact that it can be instantaneous with web chat is even better. And for us, that's one of the change pieces that we'll look at going forward is that, traditionally we had more people on the phones and less people on web chats. Well, actually, do we need to flip that on its head because we're getting the same results, but much more quickly and much more efficiently? You guys have also got a log of the conversation that's been had for your compliance perspective as well. So that can be really useful for everybody involved. On the website, we were consistently updating that with any developments that we had. We also created a bespoke COVID-19 page, which had all the information on there for covering things like payment holidays, changes to our valuation situation, how to contact us, and some downloadable support stuff on there as well. Our BDMs have been available throughout, so obviously through email and through phone. They're in a position where they can do proactive meetings with you now. So if you are wanting to have that bespoke meeting with them to discuss your business needs, they are more than happy to be able to have that conversation with you and talk through the specifics of whatever it is that you want to cover off with them. So please do get in touch with your local BDM or telephone BDM. From a perspective of our response from a product scenario, we were one of the first lenders to return to market at 90% LTV for residential purchase and remortgage, as well as 85% for new build as well. And on top of that, we were the first to return with 80% on buy-to-let in the mainstream space for purchase and remortgage on buy-to-let. We also created a dedicated COVID-19 section on our growth series page, but I'll cover that off in a little bit more detail as we go further through the presentation. So this slide is about areas where we can help you and your business. So what I wanted to cover off first, before I cover off the 3 items that are in the boxes in front of you, is around the changes that we've made on our proposition since the 8th of June. So as many of you will know, we were playing in the 90% LTV residential and remortgage product space. We were one of the only few lenders that were offering 90% products, and what we found was there was an unprecedented demand for those products. So we've had to take the really difficult decision of temporarily moving ourselves from that, just so really that we can maintain the service levels that you would expect of using us. So since the middle of May, when we introduced 90% LTV products, and we're one of the first lenders to do that, we saw levels increase beyond the point that we had ever anticipated. So as I say, we took the difficult decision to temporarily withdraw those products so that we could basically look after our service standards. Now, our commitment to supporting brokers and our desire to lend is as strong as ever, and we will return to the 90% loan to value market space as soon as we can get those service levels to a position where they will allow us to do that. So that is the only factor that's at play here, but I thought it really important just to give you a bit of clarity and a bit of rationale around why we've made the decision we've made, and I hope that we can get back into that market space as soon as possible to continue the support that we've already started. What I'd like to do now is just quickly move on to the affordability and new propositions square. So affordability for us, we will use £60,000 worth of income if it is on one application, so not from one applicant, but if an application has that in total, we can use up to 5 times income on that. There are no caps on that with regards to what LTV will go up, apart from the products that are available, obviously. We're quite happy to do that for first-time buyers, so there's a bit of flexible there. With regards to new propositions that we've introduced over the last 12 months, the main one is day rate contractors. What we've done there is that we will utilise a maximum of 46 weeks income used from the current contract. There can be no more than 8-week gap between the contracts in the last 12 months, but that's still reasonably competitive. The minimum income that we require for these day rate contractors is either £300 a day or £50,000 an annum, and there needs to be a minimum of 12-month track record of contracts with a minimum of 3 months remaining on that current contract for us to be able to utilise it. Some tweaks that we've made is around the self-employed piece. So what we've done is reduced our requirement for 3 years accounts down to 2, and that's brought us in line with many in the market. And also we've got a dedicated new build team who focus on the quick turnaround times that you require when you're doing those new build cases. So please think of us for those, because you do have access to the underwriter if you so require. That isn't just for new build, that is across the piece as well, and that can often speed up that process as opposed to having to wait for emails and things like that. You can actually speak to an underwriter and have that conversation to just tick any boxes that need ticking that little bit quicker. I'll cover off the principle-based underwriting. So these are all really relevant and really topical case studies that I'm going to run through now. So these have all happened during lockdown and during COVID-19. So they're all really, really relevant and up to date. So I've got 3 examples here, and I'll just start off with this first one, which was a client who was going through a messy separation and needed to get an offer out as soon as possible. She worked in 2 jobs. One of those she had actually been furloughed from. So to get the case to fit, we needed to use the maintenance income and the child benefit that she would have received when she moved into her new home. And on top of that, we needed 100% of income from both jobs, so the furloughed job as well. This had been pushed back by 2 other high street lenders. But we stepped in and we managed to get everything turned around and offered within 14 days, which was a great result for that particular client. The next case study was where the client was self-employed chiropractor. They were earning £11,000 a year, but couldn't currently work because of the lockdown situation. But she did have £30,000 in savings to cover everything in the meantime. Her ex-partner was due to start paying £1,000 maintenance as of June, but didn't have any proof, so we couldn't actually use any of this. However, what we could do was we could use the £11,000 worth of income because we got a projection from the accountant who was also able to sort of verify the viability of the business going forward, and we were also able to get a bit of comfort from the fact that she had those savings to cover her for the period where she couldn't work. The final one I just wanted to cover off was there were 2 clients who were both furloughed, but we needed to actually use 100% of their full income. Now, I will stress here that you need to talk these through with your BDM up front because there are different nuances in all cases. But with this one, we were able to get a letter from the employer to say that they were key members of staff and that as soon as all the restrictions were lifted, they would be going back to full salary. This case was offered within 24 hours of uploading the documentation. So that shows 3, I think, really clear examples of how we've adapted ourselves to the times that we find ourselves, and also how we can still manage to turn those cases around as quickly as we can for those clients. The final point I just wanted to cover off on this slide was around product transfers. So just to put you in the picture of where we are with product transfers and how we operate at Accord, the first thing we do is we'll send a letter out 3 months before the maturity date. And on that letter it says nothing about Accord with regards to contact details or anything like that, but what it does say is that we strongly advise that you go back and you speak to your advisor and get some advice as to what is the best thing for you to do and within your circumstances. What we will then do is send another letter a month before if there's been no action taken in the interim since the first letter went out, and that next letter that goes out a month before has the same information on it. It says no contact details about Accord or how to contact us, and it does push the customer to speak to their advisor. Now, what I will say is the letter doesn't have your individual advisor details on there. There's a couple of reasons for that. One, we want the process to be as efficient as possible, so we just need to be able to send out sort of templated letters almost that guide them back to their advisor. And our view is that if the client has got a really strong relationship with their advisor, they're going to know who that is to go back to. The other point is that what we don't want to be saying is you need to go and speak to your advisor, and that advisor has changed for some reason. They may have retired, they may have moved businesses, they may have left the industry. There's a whole host of things there. So that's the reason why we set it up the way we do. But those first 2 letters strongly guide the customer to come back to you as the advisor. It is only the 3rd letter that we send out, which is 2 weeks before the maturity, which says, this is our contact details, please contact us, because in 2 weeks' time your product will mature and you will go onto the SVR, and we think that there may well be some other products that are going to be more cost effective for your circumstances, so please contact us so we can have that conversation. The prop fee that we pay for a product transfer is 0.3, so a little bit higher than the average for the industry. And the average fee that we actually pay out is £436 for the ones that we have on our books. So that's the average fee we're paying out. Now, around rate take up, so what I mean by that is when we have our first product transfer that comes along, so the first product has been completed and it's matured and we've got our first product transfer, the take up rate, so the time that it is actually resubmitted back either to Accord or sent off to another lender, is actually 45%. So what that tells us is that 45% of product transferred opportunities are actioned by their advisor, but the other 55 either come to us directly and we deal with it. What I'm really, really pleased to say is that TMA is higher. So you as advisors are actually contacting 80% of the clients that we are aware of that you've sent us business initially, and that's only leaving 20% of customers coming back to us. So there's a little bit of work to do there, but nothing like the 45% rate that we see across the wider partners that we have out there, where 55% of them are actually coming to us directly. So this really, particularly in the times that we find ourselves, is an opportunity to really be taking advantage of. So if we now look at the growth series and how that supports brokers and some brokers' businesses as well, the purpose of the growth series was really to create a library that advisors and brokers can go to inform themselves about the wider market, listen to some market commentary from some industry heavyweights, also use some of the how-to guides that we've put together that are all white labeled and can be utilized for your business, so you can put your own logo on it and it's not Accord branded in any way, and gives you the opportunity to have some documentation that has all the information in it and that you can just put your label on it. And if you're happy with it from a compliance perspective as well, because obviously we need to make sure that that function is happy with what you're utilising and putting your name to, then that's absolutely fine for you to use those. All of its content is completely free. It's a really, really broad library of information, and we've had loads and loads of really, really positive feedback from it. We've got about 5,500 brokers and advisors registered to the growth series, and you can go about that by literally just going straight onto the website. And what that does is it will ask you to register, put your name in and an email address, and then it will ask you how regularly you want to be updated with what content's been added on there. So that could be weekly or it could be monthly if you so choose, or you can just visit it as and when you feel you've got a bit of time to be able to look over that sort of stuff to see what you can do with yourself or with your business. To give you a bit of an idea of the types of things that we offer on there, so there's some podcasts on there, and the podcast can be downloaded on all platforms. We've currently had over 5,000 podcasts downloaded, and as I say, the content contains commentary from industry figures and mortgage brokers. We've had your very own Lisa Martin contribute to that, which is fantastic. And we've also had brokers themselves contribute to that. Those tend to be the most popular ones because it's about the industry leaders and their commentary, and also brokers with what they've done in the market and how they've made their businesses successful. And as a community, you guys want to learn about what they've done so that you can either emulate that or tweak it in some way to do that within your business and drive the growth of your business forward. The other thing is blogs. So we've had over 11,000 blogs that have been viewed since launch. So this is another piece of information that you can access, and you can utilize the content of those. The how-to guides, so as I say, I've already touched on those, but the types of things that we've got on those, we've got about just around 50 of those on there at the moment. And as I say, they're white labeled guides. One of them that we've got that's been really, really popular is the taxation one, which, as I say, you can download. It's free to do so. You can pop your own logo on there, and then it's branded as if it was your own. All I would say is with things like the taxation guide, just make sure that your compliance function is comfortable for you to use those. But overall, there's a real wealth of content there that you can use from that library. And something that we've done more recently around COVID-19 is there is a specific page with specific content that we've either pulled out of past content or fresh content that's gone on there that is really relevant to where we find ourselves today and the world that we face and the challenges that our businesses are up against. So please have a look at that, and I'm sure you'll find it really, really useful. Just to summarise what we've sort of covered off, this is just a links to further information on items covered. So we've got the growth series content that we've spoken about. So you've got the link to the growth series homepage there, and then you can navigate off to the podcasts, etc. from there. There's also the COVID-19 specific growth series homepage, which will give you the information and content that we've put together specifically for the times that we find ourselves in at the moment. On the criteria side, there's a dedicated COVID-19 page for our policy updates, so you can keep abreast of those as and when they happen. And then finally, we've got the link to the criteria search engine, which will just allow you to type in some keywords and bring up the key bits of criteria that you're looking for that particular case that you've got on your desk at that moment in time. Thanks everybody for your time today. My name's Andy Millard. I am the Corporate Account Manager for Accord Mortgages. We've spent about 20-30 minutes together today just covering off what we offer with regards to proposition or criterion products. If you have got any questions about any of that or any of the other stuff that I have covered off today, please feel free to pick the phone up to your telephone BDM or your local field-based BDM. As this is a pre-recorded webinar, I do still want you to have that opportunity to have that question and answer session if you want to. All of those guys are more than capable of answering any of those questions. So please, please, please get in touch with them if you have anything that you do want to cover off with them. Thanks again for your time, and I'll see you all again soon.